Now, I don't know how many times I have to come out in front of the camera and say it, but it takes what it takes. Dividend yield is not everything, and therefore it shouldn't be your end-all deciding making factor when it comes to your next investment move. However, what does matter for all of us investors, dividend investor or not, is total return. Now, that's the performance measure that reflects the actual rate of return of an investment or pool of investments over a given period of time. It's ultimately what you bring home, and you want that number to be as high as you can possibly get it. And I am sharing this with you now because we're about to cover some dividend ETFs that specifically target growth. And far too many investors are focusing on yield, which, if you have, again, a handful of years to decades worth of time to spare in the market, is actually going to backfire on you, or at least not get you to where you want to go and ultimately hit your financial freedom goals. On that same note, understanding if a dividend growth ETF is for you requires you to become well aware of your investor profile, which factors in your age, investment timeline, and risk tolerance. All incredibly important factors for you to understand before you even think about investing in general. However, I'm going to save all of that for a different video in order to jump now into the ETFs. Up first, I want to discuss the Schwab US Dividend Equity ETF, ticker symbol SCHD, which is not necessarily your go-to when it comes to dividend growth. However, I'm mentioning it because this ETF does deliver through on sustainable growth, provides a ton of safety for even the most risk-adverse investors, and is just the dividend community's holy grail. Now, I'm also going to be using this ETF as we go to show you that there are just far better options out there, again, depending on your profile. But either way, let's pop open the hood when it comes to SCHD to discover its objective, which was ultimately to track, before all the fees and expenses, the total return of the Dow Jones US Dividend 100 Index, which should immediately key you into the fact that we're talking to investors who either need or want more of a buffer from market volatility. Yet, I do like to point out here that SCHD, as per the Schwab team, is recommended to serve as a part of the core or complement a diversified portfolio. Now, in terms of the fund's profile, it was created back in 2011, so it has established itself quite well since then, with a total assets amassing to over $61 billion. And in terms of a holdings count, we're talking about 103 holdings within it as of this video, with the top 10 holdings working out to Home Depot, Verizon, BlackRock, Cisco Systems, Texas Instruments, Pfizer, Lockheed Martin, Bristol Myers Squibb, Chevron, and Coca-Cola. All companies that are dominant players in their respective industries, but more notably, none of those are movers or shakers within the realm of, say, tech, where a lot of the growth is ultimately going to stem from. However, clicking into the fund sector breakdown, we're going to see over 17% worth of the fund's weight in financials, 15.5% in healthcare, another 14.2% in consumer staples, 13.3% in industrials, and 13% in energy, equating to over 72% of the fund's weight in those 5 sectors alone. Now, SCHD is going to deliver through on the biggest yield out of the bunch today, coming in at 3.64%, but bear in mind I said that yield isn't everything and shouldn't be the biggest considering factor when you invest into a fund. Nonetheless, in terms of performance, if you invested $10,000 into SCHD 10 years ago, you'd now be sitting on roughly $29,880.78. And the Schwab team would only be taking $6 per $10,000 invested, with that expense ratio coming in at 0.06%. Now, our next ETF is where we're really going to start to talk about the power of investing into dividend growth. And right off the bat, I want to show you that it's going to outbeat SCHD by about 11% in terms of share price appreciation alone. And it's not even the top performer on today's list, but it's an insanely consistent and reliable fund with a low expense ratio. So with that, we have the Vanguard Dividend Appreciation ETF, ticker symbol VIG, which will shift our focus from the Dow to the S&P, but seek to track the sole performance of equities that are dividend growers. Now, this fund is also passively managed, so it's going to help keep expenses low. But the nice part about this fund is that we are talking about stocks with track records of dividend growth that excludes stocks with the inability to consistently grow their dividends. And because of the growth orientation, you're actually going to see that Vanguard gives it a little bit higher of a risk rating here at a 4, but in knowing we're just talking about dividend stocks specifically, well, that risk rating is almost useless in my opinion. But scrolling down here to the fund's characteristics, we're going to discover that it's made up of 337 holdings with a total assets surpassing $100 billion. And we can continue to scroll on down here to discover exactly what I'm talking about in terms of growth orientation, with 23.3% of the fund's weight being invested in technology. Then we have another chunk of the fund's weight invested in financials, coming in at roughly 20% of the fund's weight before tapping into safer sectors like healthcare at 16.1%, industrials at 12.1%, and consumer staples at 11.8% of the fund's weight for a healthy balance, as tech and financials make up all about 50% worth of the fund. But with the growth orientation comes a much larger total return, which is again what we're after, and a smaller dividend yield. But it all just may be worth it depending on your investor profile. So that yield's coming in at 1.67%. However, if you invested $10,000 into this fund 10 years ago, you'd now be sitting on $31,314.26 today. And all for the very same cost as SCHD at $6 per $10,000 invested annually. But investors, we are only really just getting started in terms of dividend growth ETFs that outshine VIG. So before I actually cover the next two, I want to invite you to join the community by subscribing. It goes a heck of a long way in telling me that I actually made the right decision in quitting my corporate job to spend more time with all of you and designating that time to actually help you out free of charge with stock ideas, macroeconomic insights, and having some real masters of the market join me every single week to better help you as an investor. Now, while you're at it, let me know that this content is in fact delivering value to you by tapping on that thumbs up button, so I know I did my job, at least on this end of the camera. With that, let's get back to it with the iShares Core Dividend Growth ETF, ticker symbol DGRO, which in my opinion really doesn't get the attention that it deserves, but it's nonetheless a powerhouse, as it's not only been outperforming SCHD and VIG year to date, but on the 5-year as well, which means it really should have your attention and at least bare minimum be on your radar. Now, DGRO performs as it does thanks to the focus on tracking all US stocks which have a focus on dividend growth. Now, that's irregardless of where they're listed, and in order to be welcomed into this fund, a stock has to prove itself as a worthy dividend growth stock. Now, in terms of the fund's makeup, we're going to discover that it holds 412 stocks within it and nets assets over $30 billion, so less than VIG, but nonetheless a power player. And sector-wise, we're going to discover that the vast majority of the fund's holdings lie in the financial sector, coming in at 18% of the fund's weight, before tapping into tech at 17% of the fund's weight, followed by healthcare at 16% of the fund's weight, and industrials as well as consumer staples at 12% and 10% of the fund's weight respectively, which all work out to holdings like ExxonMobil, Microsoft, Apple, JP Morgan, Johnson & Johnson as the fund's top 5 holdings, followed by Chevron, AbbVie, Broadcom, Home Depot, and Procter & Gamble to top off the top 10 holdings. But it all comes down to the dividend yield and expense ratio, and most importantly, the performance over time. So dividend yield wise, the fund boasts a small but mighty 2.25% yield. It's coming in a bit more costly here for the investor at an expense ratio of 0.08%, which is only $2 more than the past 2 funds, but well worth it considering a $10,000 investment made into DGRO made 10 years ago would have yielded you $21,396.32, allowing you to sit well over $31,000. But investors, if you're really keen on total return, not distracted at all by what everyone else is after, which is dividend yield, you have to look into the WisdomTree US Quality Dividend Growth Fund, that's ticker symbol DGRW, which was solely designed to track the investment results of dividend-paying large cap companies with growth characteristics within the US equity market. Now, it's said to be paired well as a complement to high-yielding dividend strategies or as a replacement for large cap quality strategies altogether. But I'm going to warn you now that DGRW is not your fund of choice if your primary concern is nickeling and diming on the expense ratio, as that comes in at 0.28%. However, if you decide to overlook that expense ratio, you're in for a real powerhouse with a real track record dating back to 2013 with assets under management of over $14 million and exposure predominantly in tech, almost 30% worth of the fund's weight coming in at 28.9%, followed by 16.4% of the fund's weight in healthcare, 12.2% in industrials, 11.6% in financials, and consumer staples making up about 10.6% of the fund's weight, which all ultimately work out to Microsoft and Apple, Broadcom and AbbVie, Johnson & Johnson, Nvidia, Home Depot, Procter & Gamble, Coca-Cola, and United Health as the top 10 holdings of this fund. And they will work powerfully together with the rest of the fund's holdings to drive home a 2.1% dividend yield. But overall, total returns here, if you invested $10,000 into this fund 10 years ago and just left it, you'd now be sitting on $34,927.04 today. Now, just so you could see all of these ETFs side by side, SCHD is our weakest performer, all growth factors considered, with DGRW coming in much stronger in terms of total returns, yet a heftier expense ratio for those first-class returns. With that, investors, let me know which of these ETFs you're invested into, if any of this information has swayed your opinion at all, or if you have better ETFs in mind, comment down below to let me and the entire community know. If you you yourself haven't really been seeing the returns that you were originally seeking when investing into the market, click this video right here to avoid all of the mistakes that I made. Now be sure you're also subscribed to the channel, and I'll catch you in the next one.